Money has rules. They are not written in your country's constitution, nor are they taught in school, but they have silently shaped wealth for more than 300 years. Those laws decide who rises and who remains trapped. And the most curious part is that most people have never even heard of them. Let me ask you a question. Have you ever wondered why wealth always seems to flow in the same direction? The rich stay rich, the poor keep struggling, and middle-class families work harder and harder, but continue falling behind. It's not luck, it's not conspiracy, it's law. An invisible law that has existed since the beginning of the 17th century. Before we start, do one thing. Leave a comment below saying where you're watching from and what time it is now. I want to see how far these laws of money have traveled, across countries, generations, and time zones. Now let's go to the first rule. It's known as Gresham's Law. Simply put, it says, bad money drives out good. 3 centuries ago, when coins were made of gold and silver, rulers began mixing in cheaper metals to stretch their reserves. People noticed. They began hoarding the pure coins and spending only the debased ones. Over time, the real money disappeared, and the fake remained in circulation. That same law is still alive today. The difference is that metals have been replaced by credit, debt, and trust. Think of it this way. When central banks flood the system with cheap money, low interest rates, and easy loans, that bad, inflated, borrowed, and devalued money drives out the good, saving, patience, and discipline. People stop saving and start speculating. They chase quick gains instead of lasting stability. And who benefits? Always those closest to the money printer. Banks, large corporations, and the funds that receive the first wave of new dollars. By the time the money reaches you, through higher prices, wages, or loans, it has already lost part of its value. Gresham's Law isn't just history. It's your purchasing power melting year after year. Now comes the next rule, from a 17th century economist named Richard Cantillon. His discovery is simple but devastating. Money is never neutral. When new money enters an economy, it doesn't affect everyone equally. It's distributed unevenly, enriching some and eroding others. Today, we call this the Cantillon Effect. Imagine the economy as a field, and the new money as water poured from a bucket. The areas closest to the source get soaked first, while those farther away stay dry. In today's world, that source is the financial system. When governments spend and central banks print, the first recipients, investors, corporations, and asset owners, get rich quickly. Meanwhile, workers and savers feel prices rise long before wages catch up. You experience inflation's impact long before you see any benefit. This isn't theory, it's data. After the 2008 crisis, the Federal Reserve injected trillions into the system. Stocks tripled, the wealth of the richest 1% exploded, but median family incomes stagnated. Housing costs soared. That's the Cantillon Effect in real time. A law written 3 centuries ago that still controls the present. These ancient laws not only explain the past, they also predict the future. Every time governments try to fix the economy with cheap credit, they reinforce the same pattern. Bad money drives out good. The first to receive the new capital get richer, and the last in line pay the bill. You might think this is unfair, and in a way, it is. But these laws aren't evil. They're structural. Just as gravity pulls everything downward, money flows in predictable ways. When you understand that flow, you stop fighting it. and start positioning yourself differently. Think for a moment. Why does every crisis seem to reward the same people? Why does every recovery lift asset prices even higher? Why does every solution create an even bigger bubble? That's not a flaw in the system. It's the design. It was created centuries ago, when the first economists studied global markets and realized that money behaves like energy. It moves toward where it's treated best. But there's a third law, older than Gresham's or Cantillon's, and even more relentless. It's known as the Pareto Principle, or the famous 80-20 rule. In any system, 80% of results come from 20% of participants. Applied to wealth, it means that 20% of people control 80% of resources. And when that imbalance isn't checked, it intensifies. 10%, 5%, even 1%. You see it everywhere. In 1896, Italian economist Vilfredo Pareto observed that 80% of Italy's land was owned by 20% of its citizens. Today, the same pattern repeats in global wealth, corporate profits, and even digital attention. A small minority dominates the majority of outcomes. This law survives through the centuries because it's not about politics. It's about human behavior. In markets, those who understand money multiply it. Those who don't lose it little by little to inflation, taxes, or bad timing. The system doesn't reward effort. It rewards understanding. And most people never studied the rules. Let's connect the dots. Gresham's law explains why currencies deteriorate. The Cantillon Effect reveals why new money always benefits those at the top first. And the Pareto Principle shows why inequality grows over time. Together, these three laws form the invisible foundation of modern finance, a structure so old and efficient that neither wars, revolutions, nor crises have erased it. But here's the paradox. The same laws that widen the gap between rich and poor can also be used to escape it. When you understand how they work, you begin to move differently. You can choose assets that resist devaluation. You can get closer to the source of new money through investments, ownership, or enterprise, instead of standing at the end of the line, receiving what has already lost value. Think about this. Every financial crisis you've lived through, from 2008 to 2020, is just a repetition of these old laws. Money expands, quality falls, the first win, the last lose. The numbers change, but the rhythm stays the same. And it's precisely that rhythm that separates those who play the game from those being played by it. In the 19th century, these laws began shaping entire nations. Industrial revolutions, trade networks, colonial empires, all running on the same silent mathematics. Whoever controlled the issuance of money controlled the outcomes. Those who received the new capital first built empires. Those who received it last paid for them. It was in that context that the modern central bank was born. The first model appeared in England in 1694. The Bank of England, which began issuing paper notes backed by gold, lent to the crown, charged interest, and expanded the money supply through debt. Gresham's law took effect immediately. Each time paper replaced metal, real value vanished from the system, but the power and leverage of the financial elite grew. That model spread rapidly. France followed, then the Netherlands, and later the United States. By the 20th century, the Cantillon Effect was no longer a side effect. It was a strategy. Central banks began manipulating demand, stimulating economies and financing governments with credit. And as always, those who touched the new money first, banks, funds, corporations, became even richer. Meanwhile, ordinary savers and workers paid the silent bill of inflation. Today, that structure defines the entire global financial system. Each bond issuance, bailout, and quantitative easing repeats the same ritual. First receivers prosper, everyone else adapts. Gresham's law acts when excess credit drives out productive capital. The Pareto Principle ensures concentration persists. You see it when real estate becomes unaffordable, when young people give up on buying homes, when the cost of living rises faster than wages. These aren't isolated problems. They're mathematical consequences of laws that never changed. Do you want proof? Look at 1971, the year the United States abandoned the gold standard. Money turned into pure credit. From that moment on, debt and currency became the same thing, expanding side by side. And just as Gresham predicted, when good money disappears, the system fills with quantity. Inflation rose, savings lost power, and investing became a game of speculation. The Cantillon Effect did the rest. Banks, corporations, and asset managers multiplied their fortunes through financial leverage, while ordinary people saw prices rise faster than their incomes. The Pareto Principle hardened. The top gained share while the base shrank. You live within that structure, and every policy response since 1971 repeats the same pattern. In 2008, credit markets froze. Central banks printed trillions. Asset prices recovered. Workers waited years for a real wage increase. In 2020, stimulus checks arrived when markets were already rising. By the time the money hit family accounts, inflation had already eaten away its value. Understanding these patterns isn't pessimism, it's clarity. Every headline about interest rates, deficits, or bailouts is just the modern manifestation of ancient laws. Names change, but the math stays the same. So the question is, how can you use that knowledge to your advantage? It begins with a shift in mindset. You must think like the first receivers, not the last. Money is a flow, an invisible river running toward those closest to the source. To avoid being swept away, you must learn to navigate, to own assets that float in that current, not just work for a wage that arrives after the tide has gone out. The truth is harsh but liberating. The system doesn't reward who works hardest. It rewards who understands best. Asset owners, businesses, real estate, stocks, productive property, stand at the start of the cycle, where credit arrives first and growth multiplies. Wage earners stand at the end, where price increases arrive before income adjustments. That's why the gap grows even during prosperity. Each round of expansion pushes more credit into financial assets, and their owners benefit twice. First through appreciation, then through easy, cheap borrowing. Want a simple example? Imagine the central bank cuts interest rates and starts buying bonds. Big companies borrow cheaply, buy back their own shares, and investors see prices soar. Executives get million-dollar bonuses. Now look at the other side. An average family sees their savings yield less. Rent goes up, and to keep up with rising costs, they must take on debt. That's the Cantillon Effect in motion, not theory, but policy translated into daily inequality. The data confirms what the laws predicted. Between 1989 and 2023, the wealth share of the richest 1% in the US rose from 23% to over 32%. Meanwhile, the poorer half of the population gained virtually nothing. Each crisis sped up the imbalance, and the system stayed intact. Pareto's pattern still draws the same inverted triangle. Few accumulate much, many survive with little. These dynamics aren't exclusive to America. Look at Japan. Decades of low rates and asset purchases enriched corporations and major investors. Look at Europe. Unifications transferred wealth towards central nations. And in emerging markets, a strong dollar drains capital and purchasing power from dependent nations. The laws of money belong to no country. They're mathematics, not politics. Silent, inevitable, and universal, like gravity. When confidence begins to fade, Gresham's law resurfaces with force. When people sense their money losing value, they run to what is scarce: land, metals, productive assets, or even digital stores of value that cannot be printed. It's the same instinct ancient merchants had when they hid their pure silver coins, refusing to trade with debased metal. Today, that same reflex moves billions. Investors shifting from fiat currencies to gold, real estate, or crypto. It's not fashion, it's survival. But this creates a dilemma for those in power. To maintain growth, central banks must keep expanding credit. Yet each expansion weakens money's quality, driving more flight to real assets and eroding confidence further. To restore it, they tighten liquidity, which slows the economy. It's a dead-end cycle, a mathematical maze whose last supporting pillar is faith. Faith in governments, in currencies, in contracts. When that faith trembles, the entire financial structure shakes. And that's exactly where we are. A world sustained no longer by gold or productivity, but by collective belief. Belief that the digits on a screen have value. Belief that infinite credit can last forever. Belief that the next crisis will be controlled. The problem is that imposed faith always expires. History shows no empire survives the erosion of trust. Spain collapsed with adulterated silver. England rose through paper debt. The United States ascended through credit. Now the digital era repeats the same cycle, only with zeros and ones. Money is now code, but the laws remain the same. Lady Gresham still separates the real from the illusory. The Cantillon Effect still decides who wins first and who pays last. And the Pareto Principle still dictates that a minority accumulates what the majority produces. You can change the format, the name, the interface, but you can't change gravity. It attracts everything, even value itself. The future of money has already begun, and it didn't come to liberate, it came to measure. Central bank digital currencies promise efficiency, but hide something greater: control. When money becomes programmable, it can be limited, monitored, conditioned. Those closest to the source will still receive it first. The ordinary citizen will still receive it last. Promises of inclusion hide the same pattern as always. A new form of financial surveillance disguised as innovation. History merely swapped yellowed paper for invisible algorithms, and private tokens follow the same script. Each cycle begins with insiders accumulating huge stakes. Then comes mass adoption, frenzy, collapse. The pattern repeats. The first exit before the fall, the last remain with the illusion. When excess promises flood the market, good projects disappear, hidden, preserved. Meanwhile, bad ones keep circulating. Confidence dissolves, and old Lady Gresham whispers again. Bad money drives out good. Among nations, the logic is identical. The dollar still plays the role of dominant currency. Whoever issues it wins first. Each new dollar entering global trade strengthens US access to credit and real goods. Other nations, receiving it last, absorb the devaluation. The result is predictable. The world searches for alternatives: gold, commodities, parallel currencies, new economic blocks. It's the same ancestral cycle. Money corrupts, power shifts, faith reinvents itself. From 2000 to 2023, global debt quadrupled. Every bailout, deficit, and stimulus pushed humanity deeper into dependence. Debt became the very asset, and the financial system turned into both buyer and regulator of itself. Central banks buy the bonds governments issue. Private institutions use them as collateral. Markets pretend stability. Because now the state is the market. It's the peak of the Cantillon Effect. The creator, the financier, and the beneficiary have become the same entity. But here's the paradox. The system cannot stop without collapsing, nor continue without corrupting. Cut credit. Prices fall. Print more. Currency rots. The only path left is perception management. Extending terms, diluting rates, manipulating expectations. Meanwhile, the public keeps believing control exists, but it doesn't. What exists is theater. A rotation of masks, cosmetic adjustments on a body already in circulatory failure. And still, the machine spins, because no one can afford to shut it down. Money, in the end, was never just about numbers. It's about human behavior, the cruelest mirror of instinct. It shows who understands the flow and who is merely swept by it. Most people work for money. Few make money work for them. Most fear losing it. Few understand that true power lies in mastering the logic that moves it. Because money, in essence, is energy. And energy always flows toward the consciousness most prepared to receive it. 3 centuries of financial history prove the same equation. Those who understand the invisible laws rise. Those who ignore them repeat the cycle. People believe wealth comes from luck or talent, but it comes from understanding. Gresham warned about quality. Cantillon showed the sequence. Pareto revealed the concentration. Together, they drew the map of inequality, not to condemn the world, but to teach how to escape it. The secret was never to change the game, but to understand its hidden rules. The system doesn't reward effort, it rewards comprehension. The worker who trades hours for wages stays at the end of the line. The observer who perceives the flow before others moves ahead. He understands that every headline, every rate, every promise of stability is just another layer of the same theater. While some react to fear and inflation, others move in the opposite direction, accumulating what doesn't devalue, positioning themselves where money is born, not where it dies. In the end, time is the most valuable asset. Every crisis is a silent redistribution, not of wealth, but of awareness. The distracted lose, the attentive move, and that is the truest law of all. Power flows to those who understand it before others realize it has shifted. So, when this video ends, don't see money as villain or savior. See it as a language. It speaks to those who've learned to listen. And the sound it whispers between the lines of crises and cycles has been the same since the beginning of time. Wealth follows lucidity. Stay alert. Question everything. The laws of money never change. Only the blind keep believing they are free. If this message made you think, support it. Subscribe, like, and share this content with those who haven't yet awakened. Because true freedom doesn't begin with money.